I'm delighted to be here to talk to you about my favorite subject. Let's talk money. We have had a difficult relationship with money as Indians. We used to be a really rich country, then we slipped into poverty with the invasions, and then colonialism got us into abject poverty. When citizens have no hope of ever doing well, they begin to put poverty on a high moral ground, on a pedestal, and they begin to call the rich, the filthy rich. They call wealth Haat ka mail. And this is what has happened to our country. Even after independence, the country took a socialist road where, again, poverty was put on a high moral ground, the rich were called bad words, profit was a dirty word. And it took till 1991. We got political freedom in 47, but the economic freedom began in 1991 with what is called the removal of the license Raj. And since then, it's been a different journey. So those of us who grew up in the 70s and 80s, we know what socialism, the deprivation that socialism gives to you on a day-to-day basis. A lot of you who are born after the year 2000 have no memory. You don't know about it. You can only hear about it from our stories, and you don't want to go there. So it's a new way of thinking about money. Being rich is good. Aspiring for a good lifestyle is fantastic. So there's a new way of thinking about our lives and our relationship with money. But a lot of products that we use and the way that we think about wealth creation is still very 1970s. Hum hai naye to andaz kyun hai purana? And that's what I'm going to talk to you about. A new way of creating wealth. So let's say that there is a person in 1981 and he has 4 lakh of rupees to invest. He's choosing 4 products. He's putting 1 lakh in a fixed deposit. He's putting 1 lakh in a public provident fund. He's buying gold for 1 lakh and he's buying the Sensex, the 30 stock index with that 1 lakh. There wasn't a way to buy all 30 stocks in one go then, but it's a thought experiment. Stay with me. Now, 40 years later, what do you think the result of this buy and hold strategy might be? The fixed deposit is worth about 34 lakh. Not bad, you say. The gold is about 36 lakh. Even better, the public provident fund is 47 lakh, and that sounds good. The money in the Sensex is worth 3.3 crore. And you heard that right. 3.3 crore is the value of that 1 lakh which was put in 40 years ago. The difference between the old way is in lakhs and the new way is in crores. Not for a moment am I telling you to start jumping into the stock market by buying either individual stocks or day trading or futures and options. I'm giving you a way to put on lots of safety belts and allow the markets to grow your money long term. And this is how we will do it. When you start to swim, when you begin to learn to swim, how do you do it? Do you immediately jump into the deep end? Most people don't. We begin in the shallow, we slowly learn the strokes, we learn how to breathe. Then we get the confidence, go to the middle, still holding the sides, and then we strike out into the deep end. That's what we will do with our money. And the first thing that you do is to separate your saving from your spending. Now, it seems like a very simple thing to do, but it's a very powerful hack. You are putting away every month money that you intend to invest. We are not starting to invest, not right now. We are building the habit of putting away a little bit every month to see what the saving and spending rhythm might be. So maybe you can create 3 bank accounts, your income account where everything drops in, your spend it account from which you spend, and the third is your invested account where you start accumulating your savings. The first product you build is something called an emergency fund. We are not starting to build long-term money. We are not starting to do retirement planning. We are saying stuff happens, you need money, You can get fired from a job. There can be a toxic office you want to exit, toxic relationship you want to exit. This is oxygen for 6 months, which we all need to build. Use a fixed deposit. If you don't understand debt funds, if you don't understand other products, use what you know, because this is your security belt. This is your oxygen mask. So the first product you build is an emergency fund. Then you start thinking a little long term, and the extended family gets in and says, life insurance kara lo, because that's the 70s way, that you bundled the life insurance cover with investment and you put away money long term. Never bundle insurance and investment. Life insurance is a protection cover needed by the principal breadwinner of a family who is building a large corpus in case he or she dies midway. All right, so that's the purpose of life insurance. For a small premium, your beneficiary will get a large corpus. When you bundled insurance and investment, products like money back endowment do, neither do you get a good life cover. The returns on the investment are very thin, hardly 2-3%. Your fixed deposits do better, PPF does better. Do not waste your money. Do not strangle your money through these products. Then we come to the next most favorite 70s, 80s product, which is real estate. Flat kharid lo, let's buy land. The problem is that we don't consider all the costs of real estate. We don't look at the annual return that investment might have earned. We look at large monies that I put in this much, this has come out, and we feel happy about the numbers. But you do an average annual return and it doesn't look that great at all. Plus in India, there's a problem of cash transactions in real estate. And once you ride that tiger of either giving or taking in cash, very difficult to exit. So one house in which you live in, which is your own, is great. But real estate as investment, it's illiquid, stay away. And then next we come to equity. There is a way to use equity, to use markets, to build wealth long term. And the product that you use is called an index fund. What is an index fund? It is simply a mutual fund which tracks any index. The index that I'm recommending is the Sensex or the Nifty 50. These are broad market indices on the Indian stock market. There are lots of listed companies. Okay, the company will list on the stock market. The shares are available for purchase from investors. As the company grows, makes profits, it reflects in the dividends that it pays out, and the potential for higher growth shows up in the rise in the stock price. So the stock market is not a satta, it's not a lottery. There is a science to it, and it can be used for investors like you to build wealth long term. So an index essentially is reflecting of the underlying stocks in the market. So for example, the 30 stocks in the Sensex and the 50 in the Nifty 50 will be the sunrise sectors in an economy, the best stocks in terms of liquidity, depth, growth, profits. These are usually mature companies. They are usually some of them are called blue chips. So when you buy Sensex or the Nifty through an index fund, you are holding some of the best companies in a stock market. Then you ask, what happens if a company stops doing well? Well, there's a formula which allows a company in to the index and also throws it out if it stops to perform. So the companies which were there in 1981, 30 stocks in the Sensex, less than 6 still remain. The entire portfolio has got changed. You've got new stocks coming in. The old one gets thrown out. So without you having to do anything, you are always holding the best stocks of an economy. That's the beauty of index investing. For a very small price called an expense ratio, you are always holding the representatives of the growth in a market like India. The next question is that how long do I hold this for? Because everybody wants to know, should I enter, should I exit? When is a good time to enter? When is a good time to exit? This is the money that you put into the stock market is money which you don't need in the next 7 years at least. Okay, so your investing horizon is long term. You're not doubling your money in 2 years, 3 years. This is long term growth of your money. At least 7 years you have to give it for it to be able to show performance. Okay, so do not try and time that markets are down, markets are up. When I began my career, do you know what the value of the Sensex was in that year? It was around 2000. What is it now? It's a multiplier of that. The index will reflect the growth of an economy. So it's always a good time to onboard with small amounts which you plan to hold for a long time. How much should you hold? Now, the closer your need is to today, the more liquid debt products you hold, like fixed deposits, like bonds, debt funds, if you understand them. The further away from it, you can go aggressively into equity. A rough rule of thumb is 100 minus your age. So if you're 30, then 70% of your portfolio is equity. At 70, you are still 30% in equity. You are almost never fully out of equity. So this market timing approach is not something which works. You onboard and you stay on board with this product. How much are you going to expect? What we've seen, the long term, if you backtest, the Indian markets have done about 14.5% average annual return over the last 30, 40 years. There's a simple formula which helps us to predict what the markets, on an average, broad markets might do, which is GDP growth plus inflation plus what is called equity premium. Given that we are entering a 20, 25-year period of sustained growth, we should not just maintain this 14%, but probably breach it. And this is what you can expect over the long term by simply riding the India story through an index fund. You must give your money the boost, the wealth creation that equity markets can do. So make your money work harder than you do to earn it.